Cash flow is more important than accounting income for a company. Therefore, in this video, we are going to look at how to calculate the net cash flow generated by a company by using its assets. And we call it cash flow from assets. We use the initials to represent it. So that's CFFA. There are two ways to calculate cash flow from assets. One is by looking at its operating activities. In that case, cash flow from assets just equals the operating cash flow minus the spending. And the operating cash flow is just the cash generated by the company's day-to-day operating activities. Okay, and there are two types of spending. One is in the long term and one is in the short term. So the net spending in the long term is called net capital spending, and we are going to use NCS to represent it. This is the any net spending on the company's fixed assets minus any change in the net working capital. So this is the spending in the short-term assets, and we use delta NWC to represent it. And we cannot get these numbers from the company's financial statements directly. Instead, we have to calculate it. So operating cash flow just equals the company's sales revenue minus any expense related to its operating activities minus cost. Okay. So in this case, we don't include depreciation or interest because depreciation is not cash flow, and interest is a financial expense. It is not related to the company's operation. Therefore, we don't include either. And this also equals earnings before interest and tax plus depreciation minus tax. So you can use either of these formulas to calculate operating cash flow. And these numbers are available on the firm's financial statements. But sometimes you might need to calculate some of the items if you are only provided with some numbers. The net capital spending just equals any changes in the company's fixed assets. So that's the company's net fixed assets at the end of the period minus the fixed assets at the beginning of the period plus appreciation. Okay, depreciation, because depreciation is not cash flow, but they are included in the company's financial statements, so we have to add it back. And the changes in the company's net working capital just equals the company's net working capital at the end of period minus its net working capital at the beginning of the period. Right? And remember that working capital is not given in the financial statements either, but we can calculate by subtracting current liabilities from current assets. Okay, so the NWC at the end of period just equals the NWC in that period, and the NWC at the beginning of the period equals NWC in the previous year. Okay, so this is one way to calculate cash flow from assets. So after we get operating cash flow, we just subtract net working capital and the changes in net working capital and net capital spending from the operating cash flow. Okay, so another way to calculate cash flow from assets is by looking at how this cash flow is spent, right? So this cash flow would be either paid to creditors, right? So that's the cash flow to creditors, or paid to the shareholders, right? So the cash flow to creditors equals the interest paid to the creditors minus any changes in the borrowing. Okay. So this means like if a firm pays some interest to the debt holders, okay, it might also like raise some new debt from the debt holders, right? So in that case, we need to subtract the new debt the company raises from the interest paid to the debt holders, right? So that is the latter amount the debt holders would receive, okay? And the cash flow to shareholders just equals, as we said, shareholders would receive dividends from this company, right? And it's also possible that the company would raise some new equity. In that case, it means there will be some money coming out of the stockholders' pocket, right? So that's similar. The company pays dividends to the stockholders, but if the company like raises some little amount from the stockholders, in that case we need to subtract that amount from the dividends paid to the stockholders, right? So therefore cash flow to stockholders equals dividends minus any like changes in the company's new equity, okay? And the company's net new equity raised just equals the common stock and paid in surplus at the end of the period. Common stock and paid in surplus minus the common stock and paid in surplus at the beginning of the period, and we can find the value for the common stock and the paid in surplus in the company's financial statement. So therefore we can calculate the cash flow to creditors and the cash flow to shareholders, right? And then when we sum it up, then we get the cash flow from assets. That's the two ways we can use to calculate cash flow from assets, and these two methods will give us the same answer.